Hi, everybody. I'm Connor, one of the planners on the dental team here at SLP Wealth, where we're helping dentists just like you build their wealth and live a life they enjoy. But today, I want to talk about something that I don't think anybody enjoys, maybe even people at the IRS. I'm talking about taxes. This comes up a lot in our client meetings when, maybe it's an associate who's worked the whole year and they've made all this money and they feel like they've done a good job, they've saved a little bit, and we're like, great, we're getting ahead. And then they owe taxes at the end of the year. And it's like, shoot, right? We made so much progress, but how are we paying so much in taxes? What the heck? Right? So what I like to share is some ways that we can lower that tax bill, right? Some ways that we can save you money. Not going to bore you with too much on taxes. We want to make this valuable. I want to make sure that everybody can save a few bucks from this. Let's talk a little bit about why do dentists have to pay so much in taxes, right? So where do all these taxes come from? And there's some that you know about and some that might surprise you. So the first one is federal tax brackets, right? We know that as our income goes up, our marginal tax rate, what we pay in taxes to the federal government on every next dollar, also increases. At $50,000 a year, roughly 48,000 this year, if you're single, or just under $100,000 if you file taxes jointly with your spouse, you jump from being taxed at 12% to 22% federally on every dollar after that. So that's one of the big jumps. And then our brackets go up and up and up. Now, most dentists, I think most practitioners are probably making more than $50,000. So the next bracket that we really need to think about is the 24% bracket. The reason that's important, if you're making just under 200,000 single, so 197 to be specific, and that goes for if you're filing taxes separately from your spouse as well, or if you file jointly with your spouse and you make 394,000, that is the line where if you cross over that, you go into the 32% bracket, which behind jumping from 12 to 22% is the next biggest jump in our tax code, right? In the tax brackets. So, what does that mean? It means if you're right at that line, that 200,000 a year or 400 as a couple filing joint, there's a lot of value in finding those deductions and those things that can bring your income down so that you don't pay an extra 8% income tax, right? On those dollars that are above that amount. And there's a lot of ways to do that. But that's just one thing to be cautious about. So we know federal brackets. Then we have state tax brackets. So very dependent on the state that you live in, right? If you're in Texas or Florida, you don't have any state income taxes. If you're in California or New York, I think we know what that looks like. It's a little bit expensive. The highest tax bracket in California, by the way, which is the highest in the country, is 13.3%. Now that's for really, really high earners, but very standard in California, for instance, to pay about 9%, 10% in state income taxes. For a lot of states, I live in Chicago. Illinois is right at 5%. Quite standard. There's a lot of states that have 3 to 5% income taxes. Let's assume for a lot of dentists, your federal tax bracket may be 24%, and then your state tax bracket may be 5%. So let's say we're talking about 29% marginal tax rate now. Then we have your income-driven payments on your student loans. That's another income tax, right? If you're getting your student loans forgiven, let's say you're paying on the new version of the IBR, income-based repayment plan, or pay-as-you-earn, it's a 10% income tax, right? The Department of Ed asks for 10% of your AGI, your adjusted gross income, every year in total over the year, and then they split that amount into 12 payments. There's some other math in there, but that's roughly what it is. So it's a 10% income tax, right? If you're on the old version of IBR, if you took your first loan before 2014 and you're getting your loans forgiven, then you're paying a 15% income tax. Let's assume that you went to dental school and finished fairly recently and you don't have any loans before 2014. You're a 10% IBR candidate, right? So now we have federal 24, state 5, IDR 10. So we're now at 39%. So we have a 39% marginal tax rate on every next dollar that we earn. And that's reasonable, right? Very possible that your state is higher, your federal is higher if you're earning more. Now, this last one might surprise you. There's a hidden 3.8% income tax on any income that you earn from your investments in a taxable brokerage account, right? So this is not in your IRAs, not in your employer plan like a 401k. This is just in a taxable brokerage account. You pay an extra 3.8%. It's called the net investment income tax, and it was meant to help fund the ACA, the Affordable Care Act. And that applies if, when you're filing joint, you have an income between you and your partner of 250K or more, or if you're single, it's 200,000. And if you're married filing separate, as a lot of folks, a lot of dentists do to exclude their spouse's income in their student loan payments, if you're married filing separate, that kicks in at $125,000 on your return, right? So as an associate, you're probably over that, and you have an extra income tax on your investments. Not on all of your income, but we could have a marginal rate very reasonably in the low 40s. And it's very common for a lot of dentists to have a marginal rate, including student loans, in the low 50s as well. That's where our taxes are coming from. Now, I want to offer a couple ways that seems like, oh my God, what a bill. We can lower that though. You have a lot of tools at your disposal as a dentist. And I want to give you a few of those here that may save a few bucks, and just some common mistakes that we see dentists make that we work with our clients to fix, right away. Number one mistake that we see are practitioners doing clinical work for 1099 pay with no corporate entity and no S Corp election. So if you're working as an associate at a practice and getting paid 1099, which means you're not W-2, you're not on payroll, you're being sent just checks with no withholding, no benefits, no nothing, right? Just a simple check in the mail or an ACH deposit. What you need to be thinking there is, I am my own business, right? I, as a practitioner, am a business, and my business is offering my service to this practice. And so in that, when you receive 1099 income, you are subject to what's called payroll taxes for the business of you as a practitioner, right? If you don't set up an LLC or any legal entity, you are a sole proprietorship, and you have to pay payroll taxes as if you were a business paying you as an employee, which seems kind of silly, right? That payroll tax is substantial though. It's 15.3% on all of the income that you earned. That's on top of everything we just talked about: federal brackets, state brackets, right? Income-driven loan payments. So we have this 15.3% income tax, 7.6 you pay as the employee of your business, 7.6 you pay as your own employer, right? So those two combine for 15.3%. The way that you avoid that tax, that extra payroll tax, is by doing two things. One, creating a legal entity, that could be an LLC, and then two, making the election to be treated for tax purposes as an S corporation. And what that does, by electing to be treated as an S corporation, you break your pay that comes from the practice to you as the practitioner business into two different sections. You break your pay into W-2 that you receive from yourself. So let's say practice pays you, $200,000 a year. That pay would come into you as the business owner. You would pay yourself a W-2. Let's say, for instance, that's $100,000 out of that 200. That W-2 portion is still subject to payroll taxes, subject to the 15.3%. The other 100,000 is considered distributions or profits from the business of you as a practitioner. So you've effectively exchanged 15.3% tax on all $200,000 of earnings to 15.3% tax on half of your earnings. Now, your next logical thought might be, why not make my W-2 $5 a year, right? And skip the 15.3% on all of that. The IRS unfortunately doesn't let us do that. Wish we could, but your accountant will help you figure out what is a reasonable wage, is what it's called, reasonable wage. And that is the minimum that you have to pay yourself W-2 out of the earnings that your business gets. A lot of times that can be 50%, but your accountant will help you figure out that number. Just right there, as a 1099 associate, you may have saved somewhere in the order of like $15,000 if you're able to split your W-2 like that. So that is probably the easiest way to save a ton of money very quickly on your taxes, making sure you have a corporate entity and filing as an S Corp. The second thing that we see quite a bit are some of our clients not maxing out their pre-tax savings options. So what I mean by that is you have savings vehicles where you can contribute funds that lowers your taxable income in the current year. And since your taxable income as a practitioner is maybe quite high, right, including your student loan payments and net investment income tax and all that, there's a lot at stake, and you can save a lot of money by lowering that bill. Your pre-tax savings options are generally your biggest buckets. Your retirement plan at work. So if you work W-2 at a practice You may have a 401k, you may have a simple IRA. And if you're a practice owner, you may have instituted something like that for your team and for yourself. Now, you can make employee contributions to both of those plans. And then if you're a practice owner, you can make the employer contribution as well. Whether that makes sense to do requires some tricky math because it's generally made as a percentage of everyone's payroll, a contribution as a percentage of everyone's pay. So that can get quite expensive. Whether that makes sense, as an investment or not is a little bit tricky, but you can always, even as the owner, max out the employee portion of that plan at your business. And then if you are a 1099 practitioner paid by a practice, then you have access to what's called a solo 401k, which is one of the largest buckets to fill in your tax advantage savings. So a solo 401k, you can make the contribution limit of $23,500 as an employee of your own corporate entity. And you can also make the employer contribution, and you don't have to worry about contributing to anybody else's accounts, right? It's just yours. You can make massive contributions. You can put up to $70,000 a year between employee and employer contributions in total into a solo 401k. And think about that. If you were able to lower your taxable income by $70,000 in 1 year, right? That's still your money, and you've avoided an enormous amount of federal taxes and state taxes, and you've also lowered your student loan payments by, if you're on new IBR or pay, by $7,000 for the year or $583 a month, just because you saved into a pre-tax account. We see it quite often that a lot of practitioners are just maybe not aware of the extent to which they can save in each account and what levers to pull to be able to do that. So that's number 2. Number 3 has to do with our net investment income tax, and that's not using your taxable brokerage account to its fullest potential. What I mean by that is doing what's called tax loss harvesting. It has a couple different benefits, but let me explain. Tax loss harvesting is taking advantage of when the market is down. Let's say you have $10,000 invested in the stock market, and you've been adding to it steadily, every month or couple months. And then in the middle of the year, the stock market takes a dip, and you notice that some of the share lots that you purchased and you've invested are at a loss. And so what can you do? You can take advantage of that by selling those positions, investing in something very similar. So let's say, for example, you owned an S&P 500 fund, it's down in the summer, you sell that, and you invest in an S&P 600 fund, right? Very similar. You stay invested. We're not market timing. But now, if the market recovers, you've realized that loss. You've locked it in, and you can actually claim that loss on your taxes, which is really neat. So it's a way to, if the market is going to go like this over time, you can capitalize on the times that it goes down. What do we do with those losses? Let's say we realize on our $10,000 in our brokerage account, we realize $1,000 in losses. Well, that $1,000 first goes against any gains we have that year. And if we don't have any gains, if we didn't realize we didn't sell anything in that brokerage account for gains, then we get to use that on our taxes. We get to write it off against our earned income, which, remember, our marginal tax rate could be 40%, maybe even 50% when all things are considered. So on your $1,000 loss, you may be able to claim $400 or $500 in tax savings from that, right? Just from taking advantage of when the market was down, even if it comes right back immediately. So it's really powerful. Now, a lot of practitioners end up saving a substantial amount in their brokerage accounts, right? That's very common. Let's say, what if your loss that you were able to claim was bigger, right? What if you had a $10,000, $20,000, $30,000 loss that you were able to harvest in your brokerage account? What then, right? So you can use up to $3,000 in a given year against your earned income, but that's the limit. So we can take $3,000 every year. Past that, your losses get carried forward on your tax return. And so every single year they go against gains first and then against your taxable income. So if you are able to, let's say we had a bad market year, you can capitalize on that and turn, lemons into lemonade and realize losses proactively and carry those losses forward to use against your income or gains in the future. What is the biggest gain that a lot of dentists see? It's when you go to sell your practice, right? Hopefully you have a massive gain on your practice, but if you've been doing tax loss harvesting all the way through your practicing career, then you may have quite a bit of losses stacked up just from times that the market, was volatile or it was sideways or we had down years and you capitalized on that. You can use those gains all in 1 year, all in one big lump against the gains that you might have when you sell your practice. So it can save you a ton of money in a year when you may have an enormous income event like that. So those are 3 things. Hopefully that helped. We want to set up a corporate entity if you're working 1099 and file as an S Corp. We want to max out pre-tax savings options if we have them available. And then we want to use our taxable brokerage account to our advantage if we can. I hope you guys found this helpful. Hit the like button if you enjoyed this video. And if you aren't already subscribed to our channel, be sure to hit subscribe.